Perfect. All right, terrific. And we are live. I'm pleased to introduce our next guest, Rob Kahn from Eurasia Group, on this episode of Lumida Non-Consensus Investing. Rob is a managing director and chief economist at the Eursasia Group. His research focuses on the intersection of politics, economics and markets, and transmission shocks through the global economy. He has experience in financial distress, sovereign debt crises, the role of debt restructuring. Prior to Eursasia Group, he was an economic consultant and professor at Johns Hopkins University, and also a senior fellow for international economics at the Council on Foreign Relations, and a senior strategist with Moore Capital Management, and also a senior advisor in the Financial Policy Department at the World Bank. Rob's also held senior staff positions at the IMF and at Citigroup. I could go on and on. It's really an impressive and illustrative resume. You've had quite a few lifetimes there, Rob, that you packed in there. Thank you so much for joining us. I've always enjoyed Ian Bremmer's takes on social media. Could you introduce, before we get into how to understand what's impacting markets now and how investors are responding to that, including like a regional walkthrough, maybe you can just introduce Eursasia Group, what your focus is, what your clients are, and just to orient the audience on the conversation.
Well, first of all, thanks for having me on. As an introduction, I know it's a long-winded one. That one suggested I'm actually an economist at an organization filled with political analysts. Eursasia Group's the largest political advisory. We have clients that are investors, we have corporations, we have nonprofits, we even advise governments. And so all of that reflects a broad mandate to help investors navigate a global economy that's increasingly buffeted by geopolitics. And so what we do, my job in some sense is to think about the so what's. When there are big geopolitical disruptions, to think about those market and economic consequences. Sometimes it's a very near-term challenge of navigating the next 24 or 48 hours. As you can imagine, the last few weeks have had a lot of that.
Today, Thomas on the Fed chair.
Yeah, and today as well. That's right. The number of times in the last couple of weeks I've made a forecast or produce an analysis that became outdated over the course of the day is pretty frustrating.
100%.
But sometimes, look, we're looking at longer term scenarios, trying to think down the road and how the world's going to be different in 3 or 5 or 10 years, and that's also important and challenging part of the process. So that's what we do for the people we work with.
Terrific. And some of the topics, just to orient the audience, we're going to get into China-U.S. trade war, tariffs, how do they compare to Smoot-Hawley, investor reactions, how are Europeans reacting? We'll talk about China-Taiwan. And so there's really quite a lot to get into here. I'll get started with this chart, sharing my screen here. Help us understand. This is a chart showing the current U.S. tariff levels versus history.
Yeah, no, I mean, what that tells you is we are in really an unprecedented moment, right? That President Trump is seeking to rewire global trade and finance, and seeking it to do it at light speed, right? And that is an experiment we've not tried. The announcements of tariffs on Liberation Day on April 2nd went even beyond our pessimistic assumptions, our aggressive assumptions at the time.
And beyond everyone's pessimistic assumptions exceeded.
Yeah, no, I think that's right. In some ways, he told us this, but I think there was a feeling that he would temper that and take into account the risks to the marketplace. But in the end, he put in place, or announced an intention to put in place, tariffs that would have taken the average tariff rate from around 3% at the start of his administration to, on that day, nearly 30%. Now, there were, as you know, some exemptions subsequently granted, and that continues to be the case. There are certainly, as we speak, negotiations going on in Washington that could give some further concessions to some countries. But as of today, and we have a group, I have a group of colleagues that literally update on a day-to-day basis where things stand. Based on the announcements that have been made, now not all of this has been put into effect, but based on the announcements made, the average tariff rate on all U.S. goods coming in this country is around 22-23%.
When you say all U.S. goods, this means carving out exemptions for semiconductors and Apple products. Okay.
Yes.
So on everything else. So
everything else. So you have some countries that are getting 10% tariffs. Some sectors that are 25 will be more perhaps. And of course, China has a very high tariff rate that averages 100% or more, even to taking into account some of the latest announcements. Putting that all together, you have to go back to the early 1900s to find a tariff rate in the US that was anywhere close to that level. And of course, it was such a different economy then. The bottom line message is we are in uncharted territory now. We are trying an experiment on a complicated, interlinked global economy that's just never been done. And as I said before, we're doing it very rapidly. The risks of things break are pretty high.
The risks of things breaking are pretty high. Now, there's a meme that I've seen going around. It's called the art of the deal, and it orients the tariff negotiations around the art of the deal. And step one of that is you throw out an unreasonable anchor and an extreme position. And one argument is that Liberation Day was that extreme anchor. And then step two is you have multiple different objectives and lots of different messaging. And then step three is then the real negotiation starts, and the goal is to settle and land at a point that both parties find favorable and as a win, because it's much better than the initial proposal. Obviously, it's hard to. None of us has access to the strategy. We're not privy to that, but how much of that might be at play here?
Certainly, that could be an element of it. Time will tell. I do feel sometimes there's a little bit of rationalization by the supporters of the president when we hear this argument, trying to make sense of these numbers, that ultimately it will not be as damaging as it appears, that it will open doors, create market access. And certainly I do think that idea of gaining leverage in order to pressure our trading partners to remove barriers is one element of the president's agenda. Look, I mean, let's step back for a moment and kind of talk a little bit about the multiple reasons this administration seems to be pursuing tariffs. You've touched on one of them. There are legitimate concerns that have been bipartisan over the years, that our trading partners have, in some cases, had an unfair advantage or have had unreasonable barriers to our trade. And so to the extent these threats of very high tariffs force them to the table and get concessions, that certainly is one reason there. But I think there's more to it than that, or at least there seems to be. If you look back at the president's statements, really going back all the way to the 1980s, I think he has a strong protectionist instinct. I think he fundamentally sees trade as almost a zero-sum game in which we have been treated unfairly. And here's something I, as an economist, am really bothered by. He seems to have a sense that a goods imbalance, a deficit between two of the U.S. against a country in goods, is inherently a sign that things are unfair. Not taking into account other things we trade and surpluses we may have elsewhere. Not taking into account whether there are good reasons or bad reasons why we're importing bananas from a Central American country and not necessarily exporting something to them. So that this sort of basic idea that bilateral trade balance is a sign of something broken, something wrong, sort of seems to inform a protectionist mindset. And from that perspective, I think the president does want to construct a wall of tariffs around the U.S. Related to that, I think he does seem to want to increase manufacturing in the U.S. We can argue about whether that's possible or not. The world is changing. The methods of production are changing dramatically. And labor force in manufacturing has been declining for a long, long time. But he does seem to want to at least incentivize some of that to come back. That seems to be part of this idea of a tariff wall as well. And I think also revenue, right? We're in the middle of a very challenging tax debate, and both because of the rules of the Congress, but also just simply the politics around it, to the extent he can make a case that these tariffs are bringing in revenue, that strengthens his argument politically for tax cuts. So I think there's a lot of reasons why this administration and this president turns to tariffs when to try and achieve a whole range of objectives. Sometimes he just does it, I think, because he gets angry, right? And he gets drawn into confrontation. But if you put all that together, the problem is you have one instrument and you have all these multiple objectives. And I think what happened was the markets were very much hoping that your argument was the predominant one, that this was mainly leveraged to open markets. I think there's a lot more of it. And I think that's why April 2nd was such a jolt. It woke people up to the realization that we are probably going to end up with much higher tariffs than a simple leverage argument would have just.
No, I agree, mate. 2 weeks ago, he said he views the trade deficit as a profit and loss statement, his words.
Yeah.
That's zero sum, that's mercantilist. And it's actually backwards because the trade deficit actually represents the capital and financing that the rest of the world is willing to provide to the U.S. and the level of capital investment that the rest of the world is willing to provide to the U.S. And of course, trade deficits, they contract during recessions, they grow during expansions, and Apple's importing low-cost components internationally and then selling a high-value, high-margin product to their primary consumer market, which is the United States. So you're going to get a trade deficit from that. And obviously, we're financing U.S. Debt through international partners. There was one interesting theory that China might be selling U.S. bonds. They're not. They're actually buying the last 1 or 2 months. And there's really not much else China can buy. If we're not going to sell them F-35 jets, we've got export controls on NVIDIA chips. We can sell them agricultural products, but you can't sell them enough agricultural products, oil and natural gas, to offset everything else. So it's but I think you're right that he does view it that way. Now we're in this Band-Aid mode, right? We have the semiconductor exemption. We have a farmer bailout that may be coming. We have a proposed auto loan tax deduction. An export tax credit framework might be coming. There might be another exemption for Vietnam. So from what I gather, just lots of myriad groups that are voicing concerns, and you're seeing more Band-Aids come.
So I'm not thrilled with the Band-Aid model of trade policy. I use it, and I think you've described it, you've set it up well, in that it's a kind of throw a maximalist thread out there, break things, and then use Band-Aids to patch up and to try and find your way back to some appropriate middle ground. I think there's a couple of problems with that. First of all, it puts a huge burden on the government to make smart deals with 70, 80, 90 countries in the next 90 days. It's going to strain their capacity, even for the best analysts and economists. But I think even more fundamentally, trade and trading relationships require trust. And if you break that trust, that you're a reliable partner, you rip up agreements like USMCA, right? Or other understandings you have, and you basically say, no, we're going to do this. And then, okay, we're going to make an agreement if you give us things we want somewhere else. You break trust. And I don't know that it's so easy to just go back to where you were after that agreement. It also has strong economic costs, because it disrupts supply chains, trading activity. We are already seeing a stall, which I think can have important consequences for global growth. I think we probably are heading towards, if not already in a US recession as a result. But it creates enduring uncertainty. I talk to many of our clients who are corporations making long-term investments. Some of them are actually optimistic about their sectors in a Trump administration, or were optimistic, and yet now are facing extraordinarily uncertainty. What will be the tariff rate? What will be the rules of the game? Will there be export controls? What will the market look like? And it's very hard, really impossible to make sensible 5, 7, 10-year decisions about irreversible fixed investments in that environment. And so we are seeing a stall, right? We are seeing corporations frozen in terms of their ability. So even where they may see opportunities, it doesn't proceed. And so I think that's the argument where the Band-Aid doesn't necessarily stem the bleeding.
Yeah, no, I agree. It doesn't address the root cause. And we see the same thing. After the election, you had the small business confidence survey jump to 3-year highs. You had CEO confidence jump to multi-year highs. And now all of that's in reverse. You're plumbing new lows on any sentiment survey. CEOs, it's hard for them to credibly commit to any plan. If you moved your production from China to Vietnam, there was a week where your tariffs were actually higher for behavior. And then if you're moving from Vietnam to the US, but you're negotiating a deal with Vietnam, what do? Do you wait? Do you wait and see? Everyone's in wait and see mode.
Yeah. And that could take some time to resolve credibly. Yeah.
I agree. Now, how much of this, is sustained versus temporary? I see talk on Twitter about, hey, look, America's got a brand hit right now. If you recall back in the 2008 crisis, GM and Chrysler were going through bankruptcy, and President Obama at the time really intervened and gave the United Auto Workers Union something like 55% ownership of the entity, which deprived senior secured creditors of their claims. And there was a big response saying, hey, look, that's not the right thing to do. You're undermining property rights. And I was definitely on that side of it as a good free market property rights kind of person. But does anyone care? Does anyone remember? No, maybe it wasn't that big a deal. So, for the current situation, how much of this, hey, there's a hit to the brand of America, is a sustained effect, or is it just a news headline that people are overreacting to? In your conversations on the ground, are you seeing a behavior shift?
I think we are. A lot of uncertainty about this, and I think we've talked to 7 of our clients, you'll get about 9 opinions on it. But in the first days, or in the early days of this sort of unveiling of the new tariffs, in a sense, we were following the theory. The theory tells us that higher tariffs should in principle mean higher inflation, at least temporarily. It's a loss of wealth, so equities would sell off as they did, but that the dollar could be a safe haven in there. Could be a safe haven. You could see a stronger dollar. You could see lower bond yields. And we did see that. That would have been more consistent with a temporary shock that would have worked through. Prices go up and then they kind of come down and resettle, and then firms adjust to the new relative prices, the new reality. I think what we've seen over the last week is that more of a sense of something that will be permanent and lasting. And I think that's been reflected in the fact that at the same time equities are selling off, we're seeing now bond yields rise and we're seeing the dollar fall. And I think that is not just a kind of pulling back on risk, but also maybe a reassessment of the dollar and the U.S. market as a durable place to invest. Others have said this, and I find it compelling that the U.S. brand was very much based on both entrepreneurship, that it was a space in which you could, business can be creative and entrepreneurial and experimental, but it was also a place in which there was a rule of law. And you knew what your rights were, and you knew you were protected. And in that sense, it was that combination, which so few markets had, that made it a unique, risk-free market. I think, if that's being called into question, then you have a fundamental issue for the dollar that will be quite persistent. And in this regard, and here I'll say something that maybe is a little bbit more provocative and even takes us a bit outside tariffs. I think you can look at some of the other debates that are taking place now, and about that seem to point to a deterioration of norms and a deterioration of the rule of law, and say that is also feeding into an environment where, particularly as a foreign investor or a foreign citizen, you are going to have less confidence that this is a place where you can study, invest, live, and the like. And I think all of that is not easily something that sort of washes through in 3 or 6 months.
Right. I'm showing on the screen here the U.S. dollar. So U.S. dollar is now at 2022 levels. So the theory hasn't worked out, right? So Americans have to pay a higher cost of not just the sales tax, which is what the tariff is, but also the dollar value is lower, so the cost to the consumer is going to be higher, and businesses.
Yeah. I was wrong on that. My initial prediction was very much in line with the theory. I was looking at not just the tariffs, but the immigration policy, which is going to reduce our labor supply in some critical sectors, and put all that together and said, this was all going to mean stronger dollar and higher inflation.
Right. And international markets are outperforming the U.S. markets now. So there was an argument, hey, look, this is for Main Street. Wall Street's had its turn in the last few decades. Wall Street can still win, which is what Besson is saying, but it's Main Street's turn. But interest rates have gone up. Mortgage rates are at 7% plus. Mm-hmm. So it's hard to find the win in all of this. Maybe there's a longer term win around opening markets, all for that. Non-trade barrier, relaxing those restrictions. I think everyone kind of agrees the approach could have been handled significantly differently. I'm going to share on the screen here. You've got a slide about the Plaza Accord, and there's talk around, hey, look, is there a Suez Canal moment, which was a key moment in history where the U.S. dollar kind of lost its prominence. I'm not of that view. I don't see an alternative, really. It's not going to be the euro. I just don't see it. But yeah, it's worth asking the question.
Yeah, to be honest, I've been dismissive of a lot of the fall of the dollar theory. Look, the dollar is the world's dominant reserve currency. It's a powerful network. And there's really not another currency out there that I see that can replace it. To do so, it needs to be associated with an economy that is globalized, that has strength, and where the government itself wants its currency to play that role. And I don't see any country that's standing up. That's why often when you have a reserve currency, whether it was the British pound in the early 1900s, then the dollar, there's a lot of stickiness to that. So I don't think the dollar is going anywhere. That said, I have always felt that the dollar's role was a very important contributor to U.S. prosperity. And I do sense among some of the president's advisors a disagreement with that, a sense that somehow the exorbitant privilege of the dollar was a negative. It was contributing to the trade imbalance. It was undermining U.S. manufacturing strength, and it was a burden and needed to be thrown away. But, if we're in the process, in a sense, of trying to destroy the dollar's value as a global currency and trying to undermine the commitment of or the strength of investing in the U.S., because after all, if you don't want to run a trade deficit, the counterpart to your trade deficit was a capital inflow, right?
Exactly.
And so that meant that, foreigners were selling us goods and then putting their money in the U.S. as a counterpart.
Right. U.S. stocks, Treasury bonds, SoftBank investment, TSM Fab investment in Arizona.
And sure, I suppose, in principle, you can diminish the trade deficit by making us an unattractive place to invest. But I think that's a really negative way to do it.
Correct. Exactly. And the other part is that, yes, like foreigners, they're choosing to invest in U.S. securities versus other alternatives like merchandise or services. Obviously, it's hard to export services. You can set up a bank branch. That might be one way to do it, but you can't export healthcare services. This is difficult. We're a services-based economy. And that also means we have less volatility.
Now, I do think that some of the president's advisors, before they were in the White House, and I think that's important to stress, these are things they wrote when, back in the day.
When they were at Manhattan Institute.
Yeah, and when they were contributing to Project 2025, or when they were essentially articulating a vision. And all of that's fair game. It sort of had, I think a number of them understood this tension that the theory was telling them that the policies the president might embrace to promote reindustrialization and reshoring might produce stronger dollar, might produce higher interest rates, all of which would undermine, in a sense, the effort. And so some of this idea of trying to use the threat of tariffs to get everybody into the room and sit them all down and get a kind of plaza accord was attractive. It was a way of getting a cheaper dollar and lower interest rates through coordination, through negotiation, rather than through wrecking markets. And in some sense, I understand where that was coming from. The argument I would make is this plaza is not the right analogy. Plaza came in the context of a very strong dollar, when countries were really closely collaborating, and there was a shared belief that there was benefit to a weaker dollar supported by underlying policies changing, right? And so there was an effort to signal that to the markets to try and bring down the dollar. It took a while. Once it gathered momentum, actually, we needed another meeting to try and stem that decline. But that's not really the situation we're in now. Actually, it's more akin, for those who read history, to the Smithsonian Agreement, which had come a few years before Louvre, when President Nixon essentially forced our trading partners to accept a cheaper dollar.
Instead of delivering gold. And just to orient for everyone, so between 1980 and 1985, the U.S. dollar shot up in value significantly, around 50%. So U.S. exports were hurt. They assembled the 5 leading countries around the world. They met at the Plaza Hotel in New York City, and they established a currency framework to help address that. So that was the Plaza.
That was the Plaza Accord, named after the place they met to talk about it. Now, at the time, those 5 countries had about 60% of GDP. So they were a more bigger part of the global economy then, and a very high percentage of financial market activity were in those currencies. So they had a lot of credibility when they said, they were going to work towards a different currency value. We're not really quite in that world now. So it's not a great analogy, but I think it's capturing that sense. Now, we are getting a weaker dollar right now. So in some sense, the pressure of it. But I think it's still capturing that notion that this is a government that if the outcome in markets is at odds with what they're trying to achieve, may be willing to intervene in markets, may be willing to try and push jawbone or otherwise push market values. And that is a concern to investors, as it should be.
Well, markets aren't cooperating with the story, right? I mean, You've got a basis trade, the 10 years blown out. And here on this slide, we're showing U.S. Treasury securities held by foreign countries. You can see that foreign countries have increased their holdings of U.S. Treasuries over the years. At the same time, the U.S. has to refinance a lot of debt. Much of this debt was issued in the 2010s at low interest rates, including 1.5% just 5 to 6 years ago. Now you're at 4.3% plus or minus on the 10-year. And this trade deficit push, shrinking that, means less dollars to go finance U.S. Treasuries. So if you squeeze here with this objective, you're paying a cost there from a Main Street perspective, a corporate finance perspective, financing U.S. government perspective, and elevating interest rate expenses. So from my vantage point, I just see distinct policy objectives that on their face plausibly look sound, but I don't see a coherent approach, which is surprising because Bessent's an incredibly bright individual. Like his market savvy probably isn't as, rivals any Treasury Secretary, maybe until you go back to like Robert Rubin, let's say, from the late 90s.
I think the question will be the extent to which the president encourages him to speak up and respects his advice.
Yeah, it does look like a kind of a force of personality. And Lutnick, on the one hand, is more aggressive and kind of appeals to the president's instincts. And Bessent's just more thoughtful and a little bit more mild-mannered and less assertive, which maybe that's playing a role into this. Just if you could just cycle through region by region, like what are you seeing? What are you hearing there in terms of reactions, adjustments that people are doing, either from an investment or capital planning perspective?
Well, certainly the reciprocal tariff announcement on April 2nd shocked a lot of our trading partners. The arbitrariness of the equation that was chosen and the way it was rolled out, which created a lot of anomalous results, seemed unreceptive to relationships, conversations, and everything that had happened before. I think certainly caught people by surprise. As I think you know, it was essentially a simplistic calculation looking at the bilateral goods balance and calculating rates off of that. That punished a lot of our Asian trading partners. Now, maybe that was part of the appeal because there was a sense, I think the president does have a sense that trade is unfair with a lot of the Asian countries, importantly because of China's role in those supply chains. But the tariff rates were quite high with a number of Asian economies, including Japan, Korea, and other countries in the region. And so there really we're on the firing line. That's why it is not surprising to me that if you're looking at the first countries to come out and try and negotiate bilateral trade understandings with the administration to get these tariffs reduced, it's Japan, it's India, it's Korea, which in some sense have a lot on the line to try and negotiate.
Those countries have a lot on the line.
Yeah, although I would say that just looking at those reciprocal numbers, I would have said Latin America did better relatively.
Wouldn't the materiality of impact be around Mexico and Canada, like the primary trading partners?
So, of course, there's a separate dynamic that's going on with them with regards to USMCA. Mm-hmm. It certainly is the case that these countries have been operating for several years, and so politically and economically oriented around USMCA as essentially a tariff-free zone, right? Mm-hmm. And so in some sense, the president has broken with that already. Mm-hmm. Not in name, but in substance, by threatening and imposing tariffs. And it has, I think, badly damaged relationships with both those countries. Now, I think ultimately both countries understand they need to act pragmatically in that environment. I think you're seeing, particularly with President Sheinbaum, Mexico, kind of a quiet pragmatism being brought to bear.
Yeah, it seems to be a better relationship there. That's how Trump describes it.
Yeah, I think President Trump has on Canada has publicly been provocative and demeaning in ways that made it very hard. But it's also contributed a backlash. And my political colleagues at Eurasia Group keep reminding me that the swing in voter sentiment, as measured by the polls, mm-hmm. in Canada, is unprecedented. And
well, the Conservatives were going to win the election.
Before this all started, the Liberal Party looked geared to a historic defeat, and now they're
right. And then Trump handed the Liberal Party a major win. Now Trump spins it differently. He's like, well, like they're better for me to negotiate with, and
we'll see. I mean, look, Mark Carney is an experienced international negotiator and policymaker. If he were to win the election, and we now have him as a favorite at this point because of this swing in the polling, then I think he would probably approach it pragmatically as well.
We'll see what happens. Or like I think there are legitimate questions around why American banks don't compete more in Canada, for example.
It gets back to the way you framed the question at the start, because here, as elsewhere, there are legitimate concerns I think you can point to that American trading policy or trade-oriented policy makers have worried about for some time, right? Hardwood lumber,
right?
Dairy.
Oh yeah, no, I've heard a lot of.
Right, these have been issues that have been out there for a while, and indeed will likely come up in the negotiations. So there are issues that are of longstanding concern that will probably need to be adjusted. But it was handled, of course, in a way that created a lot more, distrust and unhappiness and friction that went far beyond that, and has raised questions fundamentally about whether the U.S. is committed to sustaining USMCA. Now, my view is that we ultimately will essentially recreate, for the most part, the USMCA.
That would be a major win for financial markets. If that's the case. Markets aren't pricing that in. Well, Mexico is one of the leading emerging markets, and I do believe there'll be a winner coming out of this. I just don't see a world in which you can plausibly move low-cost manufacturing from China or Vietnam to the United States. You need a Mexico, which is in your backyard, which you have a better relationship with, lower cost of transportation. It seems inevitable that Mexico has to be an important part of the solution here.
And I agree with you analytically. That's where you'd want to get to with them inside the tent and part of that. Now, you obviously have to have still complicated discussions about their own rules of origin vis-a-vis the Chinese, for example, or how, transshipping. There's obviously a set of non-trade related issues, including fentanyl and the like. So, and the border issues. So there's a lot to talk about there. But I agree with you that from a kind of efficient markets perspective, there should be a deal to be had there that is powerful and politically uniting these countries. But how you get there is still going to be a tough one. And getting back to my earlier point about extended uncertainty, how long do we live in a world where even if you're optimistic about it, you're not going to be investing your firms.
Right. You're going to wait. Exactly.
You're going to take a wait and see approach. And that's certainly what a lot of our clients are telling us is the most right now.
How credible is the case for U.S. manufacturing, right? So Nike's got 500,000 people in Vietnam working for over 100 plants doing fine stitch work. Lutnick, the Secretary of Commerce, has said, we're going to invest in advanced robotics, which can barely handle eggs. We don't have these humanoids. I'm looking forward to them, but they're not here. And so it's a mixed message. Like, well, okay, is the American worker going to take that job? I saw an interesting stat. It said 67% of Americans want to bring back manufacturing, reindustrialize, but 67% of Americans don't want a manufacturing job. It's another, not in my backyard. Someone else, please take that job.
There's very different manufacturing jobs, and I think we have to credit the great Dave Chappelle, I think, for the line of I want to wear Nikes, I don't want to make them.
Right, exactly.
Basically captures the thrust of what you're saying. Now, look, there's been a long-term trend decline in manufacturing jobs in the U.S., and a lot of it was the pure uncompetitiveness of the job, those kind of jobs. But also a lot of labor-saving investment in those sectors, right? So that even where these things are being made, even if you want to make a tire factory and put a tire factory in the U.S., and by the way, it can take 3 or 4 years to get that and to do it, or even if you want to make airplane parts that are now made elsewhere, and it may take you 5-7 years to make the factory that build the factory that makes those parts, test them to make sure they work with all the other parts you're putting into the airplane, and the like. You may need a lot less people to do that than in the past. So part of that's not coming back for that reason. It's pure
technology
right?
of technology, right?
And going forward, I think as you take into account everything from AI to other productivity enhancing innovations and services, which by the way are not being tariffed here, you're going to get more and more innovation to try and exploit those advantages. A more service-driven economy. So all of this says to me that, by and large, he's not going to be able to achieve this return of a 1970s style manufacturing world. So if he's trying to, it's going to lead to trouble. That said, look, there are going to be some jobs where they can come back if it's done properly. In this regard, I, like a lot of other economists, am very worried about how it's being put in and what economists call the risk of negative protection or negative effective protection. And let me give you an example of that, and it's one I know others have made. It's a good one, but an important one. If you're putting tariffs on the inputs to production, which has been a big part of the Trump plan, but that you're, for whether political or economic or other market reasons, not having as high tariffs on the produced goods. Mm-hmm. You have a problem there for them, in that you're creating a small number of jobs in the input sector, but you're losing a lot more downstream as this stuff is, because the protective element goes negative. So to give you the example that's currently being debated, if you tariff steel and aluminum, but you give exemptions on products that have steel and aluminum in them, you will create a few more jobs in steel and aluminum sectors. Not a lot, because it's still maybe not competitive, but the problem will be that anybody in the U.S. who uses that steel and aluminum will be at a disadvantage relative to foreign competition in their products. And so we'll lose a lot of manufacturing jobs there. And I think the calculation is, at least as we have been doing it so far, we're probably losing more downstream than we are in terms of the protection. So even there, we're not going to achieve the objectives the president has stated.
I agree. And that brings you back to Band-Aid mode. You have another Band-Aid.
Yeah.
Look.
Ask, well, why is it that, Apple gets an exemption, right? Or the autos get an exemption. Sometimes there can be legitimate reasons for that, but sometimes it can just reflect their access to the president. Some of the,
of course, I mean that's where it starts. It's the squeaky wheel gets addressed first,
and that doesn't necessarily get you the efficient economic outcome.
Correct. If you're a small business importing hockey sticks from Vietnam, you don't have that phone call. You didn't make a contribution on inauguration. You can't show up at Mar-a-Lago quickly.
And that's going to be where a lot of the damage is. And a lot of those are red state, small towns.
Yes. No, I agree. I mean, it's small businesses which vote and are dispositioned to vote Republican. And, Apple, California-based Cupertino, on average, going to tilt more left. So it is and of course he has to do that exemption. Otherwise, the price increase, the inflation shock to the end consumer is significant, and the impact to Apple's earnings, it's going to show up in one or two places. Either you got a lower profit margin, hurts your earnings, hurts your stock, hurts your multiple, and you got to remove your capex, or higher cost to the consumer. And in aggregate, you're going to get a loss in total. There's a deadweight loss somewhere.
Yeah. But I just don't think the president was prepared to. He has shown that when the damage becomes clear, he does respond. And I think he was not prepared to allow the price of, say, and I don't know the numbers specifically, but the price of an Apple phone to, say, go to $2,700.
Right. Well, I think this is where, when you approach public markets today, it's very different than it was in Q4 2018, when markets troughed at a 14 times multiple. And you had a correction then, which is about 19% peak to trough in the S&P 500. You've had a similar correction, whether you're looking at S&P or QQQ. QQQ more breached 20% S&P, shy of that, kind of like mid-teens level, right? But the difference is the valuations today are still around 19.5 and 20, and multiples are coming down as analysts lower their forward estimates. So markets are down, but the valuation level is staying the same because the analysts are lowering the forward estimates because companies have lower profit margins. So, I don't know. I'd love to hear your view on this. I'm not so sure that you can put Humpty Dumpty back together again. Right? Humpty Dumpty, here's Mr. Market. Humpty Dumpty had a big fall. The valuation levels were very high and presumed clarity. And the scope, depth, and magnitude of these tariffs are much larger than Trade War 1.0. So I'd love to get your kind of market perspective. Obviously, we're seeing very thin liquidity in markets. One interpretation of that, our institutions are just holding back and waiting for greater clarity and better prices before they commit to a longer term investment.
Yeah, but I actually worry that it is also reflecting a certain amount of stress in financial markets. A lot that is hard to price, creates counterparty concerns, makes people more cautious, and can lead to unintended consequences.
Have you seen Europeans adjust their asset allocation? I don't know if you have those kind of conversations where they're saying, gee, our weight on US, I had a chat with a private banker manages European money. He's like, look, the average weight on US equities is 70%. There's probably peak levels and coming down from there.
That portfolio hasn't done so well recently.
Right.
I'm not, but you have many people on who are better investment strategists than I am. I certainly will tell you that one thing that has struck me is that at moments like this, all the correlations go to one. And the way I think about that is, I can talk to a dedicated emerging market investor who focuses on, European and Asian emerging markets, and they want to talk tariffs. and I can go to talk to a U.S. investor, and he or she wants to talk about tariffs, right?
It's the number one topic. Yeah.
And you can't have a call on your investable universe until you have a sense of the direction of policy in the core industrial market.
Well, right, and it's hard. It's difficult to consider like a sector that's not impacted by tariffs. Maybe insurance, but automobiles, yes. Pharmaceuticals, yes. Medical devices, yes. Merchandise, yes. Retailers, yes. Apparel, yes.
So to put it it's a simplistic way to put it, but right after World War II, you had the U.S. in its leading power role decide to embrace and support a system of global economic integration, right? To create a big sandbox and to encourage countries to come and play in that sandbox by rules of the game that were supported by the U.S. And behind that was a lot of economic reasoning that there were going to be benefits from more integrated trade and finance, right? And I think that was borne out. But also there was a view that it would support global security, right? If we were integrated and traded together, we were less likely to fight each other. And I think that, in some sense, pulling that apart as quickly as we are doing now, I think creates a lot of uncertainties about it. And I used the term I used at the beginning of our conversation was the rewiring of the rules of global trade and finance. And that is what we're in. But it's not the problem, of course, is that the Trump administration and President Trump himself really hasn't, I think, a well thought through vision of what the new rules of the game should look like.
How much of that rewiring was inevitable, where Trump is a catalyst versus Trump creating that reality? Like AOC would be all for tariffs, let's say, probably.
Yeah. Left, right has different meaning. I think you're raising a critical, a great point, and it's a critical point in that I think you can go back, certainly like to the 1980s, 1990s, and say that we have been seeing a backlash against this post-World War II framework. A sense in many countries, especially the US, but not entirely, that some people were being left behind by globalization, right? And that was creating discontent, a sense for many that they were losing opportunities, that their kids' lives would not be better than their own. And that was undermining this broad-based global commitment to freer trade. I think there's some truth to that. I would think the global financial crisis was a catalyst to some of that too. A sense of dislocation in which there was really disproportionate benefits being, falling to people, different parts, sectors of the U.S. economy in particular. And yet the costs of crises, when those imbalances mounted, were borne broadly. I think all of that had been to some extent building. I think maybe the pandemic was a catalyst. And I think in that sense, as you're hinting at, Donald Trump is as much symptom as he is cause of it. And he was elected in some sense capturing that of dislocation.
I mean, the election, I'd say like he won based on a classic kitchen table approach. Hey, inflation's too high, egg prices are too high, control the border, need security, let American enterprise win. I don't know that. I do know he didn't win on his tariff campaign promises. That wasn't the main of it, right? And the interesting thing about this is that these tariffs are not popular. It's not consensus in social media. They're not fans of it on social media. You do surveys, people are not fans of it.
Yeah.
More Americans own stock than ever before, which I find comforting. The fact that the public is smarter, maybe because of social media. People saying, "Gee, this policy doesn't make sense." It is populist in the sense that it should rally up and create enthusiasm, but it's not, either because people are smarter on tariffs or they're at a small business or at a company and they're like, "Oh shoot, what the hell am I going to do here? Am I going to accelerate a car purchase?" People are thinking about that. So I don't know. I view it as like a miscalculation. I don't think.
This ties in though to another theme that we, for another time, I think,
Yeah,
but
sure.
that we talk about a lot at Eurasia Group, which is the rule of law and the erosion of norms.
Mhm.
Because at some level, I think if you off the record went and talked to Republican Congress people, they'd agree with you on that point, and they would express serious concerns on behalf of their constituents about this breakdown of trade.
Mhm.
But the political costs of standing up to the president right now are very high.
Well, the political cost of not getting a resolution quickly is also high.
It's also very high. So the question is, when do you see more courage to tell
Right.
them that this is not, you're not achieving your objectives. You need to change course, Mr. President. And but there is a lot of concern. I think Senator Murkowski today articulated there's a lot of concern of retribution, and that you have a president that has moving aggressively to consolidate authority, to use the power of the presidency against his enemies assertively. And whether that's Harvard or whether that's people he feels maligned by. And that has, in a sense, kept him from people from maybe pushing back harder.
How do you read this? This statement came out today regarding Jerome Powell, right? So Trump says Powell's termination cannot come fast enough. That was today, April 17th, 12 p.m. Markets hit their intraday highs around that time. I don't know whether
markets got a little jittery with this. But the president has in the past on a number of occasions mused about trying to fire Powell. And Powell said he wouldn't be, which sort of sets up the possibility of a confrontation. Because, and I think rightly so, Jay Powell realizes that this idea of overlapping terms with the president not being able to fire is central to the independence of the Fed and the credibility of our monetary policy. You lose that, and you're going to lose a lot in terms of the value and credibility of the dollar. So, in that regard, we're playing with fire here. Now, there is a court case. It's a 90-year-old court case that gives this precedent. It says that independent boards of a certain sort created by Congress, the head can only be fired with cause. That's because the president has fired some other people. That case is going to the Supreme Court. And the so-called Humphreys executor versus United States case could be overturned later this summer. If it is, depending on how the court does it, it could open the door for the president to be able to fire Jay Powell. And if he did it, that would be a major problem for financial markets, because it would be a very full loss of credibility.
Yeah, it would lose.
Right. Because he'd be saying not just the president can get rid of anyone he doesn't like and put in people that are subservient to his views. So you would have complete dominance of the Fed by the desires of, in this case, an inflationist, expansionist president. It would be a disaster. Now, I think Secretary Bessent understands that. I think a lot of his statements have been designed to make the point that there are other ways the president can get his view heard. And look, keep in mind that Powell's term is over in May of 2026.
Right. 1 year to go.
It's very soon. So it's going to take time to interview candidates, identify them, get them approved by the Senate. And so what the benefits to the president are so small that I'm taking this as more an expression of frustration from the president that rates are higher than he wishes they were, and is motivated by the comments that Jay Powell made yesterday, by Lagarde cutting rates today and the like. We will get more of these, but don't overread termination as threatening an effort to fire. I think he'll be very happy in May of next year when Powell's term expires and he can get someone appointed. I think how the markets react will depend on who that person is. Right.
Right. Well, we're looking at Kevin Warsh, of course. No?
I don't know what if the president. I don't know that the president knows who he was going to nominate yet, and if he doesn't, I don't know. I mean, there are a number of names out there who are very mainstream. Kevin Warsh is one. Chris Waller, currently at the Fed, another one. There are other names of people who would be very good, but there are also some very unorthodox names floating around as well. So I think we have to just take a wait and see how the president wants to go. in terms of it. If he's really desperate to get lower interest rates, he might be inclined to appoint someone who's not as committed to, maintaining the inflation target, and that would be very sad.
Right. Well, we'll take any audience questions now. If there are any audience questions, feel free to lob them in. Question: is there any impact you see here on digital assets? I read a report around China and Russia settling transactions in Bitcoin for oil. I mean, how much of that is substance versus a headline?
I think a lot of it's political. I think there is a desire on the part of some countries to show that they're less reliant on the dollar, that the U.S. can't get leverage on them through it. And one way you do that is to try and create alternative payment flows and processes. It also protects you from future sanctions. And certainly if you're worried that what happened to Russia could happen to you for whatever reasons, there may be some incentives to develop it. So from that perspective, I think it's oversold. I think it's more political than fundamental as a challenge to the dollar's role. I do think there is incentive to create these digital systems, and I think the pressure will go in that way. And I actually think we'll see significant developments in the U.S. because of a deregulatory ethic on the part of this administration, which will open the door for more accommodative.
Right. Tax cuts and deregulation are coming.
It's coming. It's absolutely coming. And you see that, so we'll get developments in that space, but I don't see it as being driven by some planned government-driven move to get out of the dollar.
Got it. Understood. Any thoughts on the pace of resolution of these trade deals? Like, how would you interpret what consensus is saying under 90 days?
Well, the president himself has set up the 90-day window, and I think there is immense pressure on his team to get something done. Now, trade deals are really hard, and they require a lot of people of skill to do this, and some of these people have even been fired, right, as part of it. So it's going to be tough. I think what we can realistically expect to see is some term sheets, that there'll be a real effort on 4 or 5 bilateral negotiations to get to a term sheet that the administration can say, look, to your earlier point, our leverage worked. We got these concessions. We got these agreements. I think there is the U.S., the Bessenton team and the Commerce team. These guys really are under pressure to get some deals done. So I think the U.S. side will show flexibility and accommodation. Maybe in the end, you'll look at these deals and say, was it really worth it all for this? But I think that they'll push for a deal.
I agree. I think it'll be faster than most people think.
Yeah.
I mean, the president can set the terms. He started it. He can choose to accept the deal.
And on the other hand, I think there are several countries at the table now who really want to get those deals done. You look at Japan; they're heading to an election, municipal elections later this year. The prime minister has strong interest in getting something done. They really want to get these tariff rates down, and so there too, I think both sides have incentive.
I agree. Any thoughts on Treasury market, and related to that, that's related also, like, do you see recession risks? Do you have views on that?
I mean, we don't, at Eurasia Group, we don't make the economic call in recession. There are better people with bigger models that do it.
Sure.
But as someone who's lived through a number of these recessions, my first job was during one particularly painful one in the early 80s. And so I've lived through some of them. And I was actually in the White House in 1991 during watching another recession take place. And one thing that has, I have some sense of how these cycles of lost confidence to reduce spending, to lower profitability, to lower income and job loss and so on, how that can build on itself. That's the dynamic of a recession. I think we're seeing a lot of that in play. Now, a lot of that's in the soft data, surveys and expectation measures. But it is building in a way very much consistent with the recession. Now, the question is, once we get through some of this inventory build ahead of the tariffs, whether we see that the actual hard data comes in. I think it will. I think there's a very high likelihood that we'll see.
Rick Reeder, CIO of BlackRock, made that recession call yesterday.
If the tariffs go in as we expect, and you end up with an average tariff rate of around where we are now, around 20, I think that's very hard not to see.
Trump also said a few hours ago that they expect to get deals done, but that the tariff rate would, quote unquote, remain high, whatever high means.
That means that he's committed to that idea of a wall, that you're not going back to where we were, that you get rates down. But certainly, this uniform global tariff at 10 probably represents a floor, not a ceiling, for where rates are going to go in these deals.
Yeah, terrific. Did we get to the outlook for treasury market? Any thought? It looks like people are more interested in treasuries now.
Well, markets do overshoot at times of fear and risk off, right? So, I mean, obviously, I think there's a lot of money on the sidelines looking for an opportunity to come back, but I'd have no idea as to whether we are at that.
Yeah, look, I've been buying bonds myself. I think bonds make sense. You have an attractive yield, and if there's better opportunities a few months from now.
There is an interesting economic debate, which is fundamental, which is what's going to be like the longer term real interest rate that we get, the so-called R-star debate. We did have this 30, 40-year period. You referenced it a little bit earlier, where we had very low real and nominal interest rates. We benefited from this global supply of savings that we were tapping into as part of this effort to integrate. If we're unwinding that, if we're discouraging it, we're going to pay more.
Right. It would also mean you're transitioning to this new regime where we just exited a regime where we had the highest U.S. equity market returns in the last 15 years, which corresponded with fiscal dominance, very low interest rates, and excessive QE and stimulus.
Yeah.
And now all of those are moving in the other direction.
Right. So, or as economists would say, R-star is rising.
Correct. R-star is rising. So what's the discount? That's the discount. That'd be part of the discount rate you apply on equities and risk assets.
I'm sympathetic to that. Lori Logan, the president of the Dallas Fed, has written a nice paper a couple months ago looking at different ranges of those estimates and making the case cautiously that rates may be, the range of rates you may have to deal with are higher than you've anticipated.
Yeah, I think that's fair. Well, any concluding thoughts, Rob? I really appreciate your time and insight around this.
I really enjoy the opportunity to talk about it.
Likewise. How can folks follow you or Eurasia Group and learn more?
Well, my boss, Ian Bremer, is active on social media, so look for him at in Eurasia Group, in the Eurasia Group tag.
Terrific. Thank you again, Rob. Until next time, be well.
Take care.
Excellent.